G'day, it's Pete Wargent here from Allen Wargent Property Buyers. A special short episode for you today, just me, talking about compound growth and how to become a compounding machine. I had somebody ask me the other day about compound growth, and they said, look, I've heard about the concept and I've heard you say that property can be powerful because of the combination of leverage, other people's money, the compound growth, and then time is that third secret weapon. But how do you become a strong compounding machine, and how can you speed up that process? That was the question. And I suppose to a certain extent, time is necessary. It's a necessary component for compounding to really get working. But let's talk today about what the three major tipping points are for compound growth, and how you can join the rich that get richer by using compounding as your secret weapon. I guess that's always the thing they used to say to us when we were growing up. You know, the rich get richer. But how do they do it? It's because of compounding. So I'm going to go through this today and just using an analogy, almost like they often talk about the snowball effect of compounding growth. Well, I'm going to instead use an analogy of a car moving up through the gears and how you can sort of speed up your compounding machine to grow your wealth over the long term. So if you imagine, I think when we were at school and doing higher education, people, a lot of the focus was on what kind of job am I going to do? What kind of career can I undertake? And of course, that's an important part of the process. But actually, getting your first job in adulthood, that's really the starting point. That's basically the neutral position if you're driving your car. I think a lot of the highest earning careers are often the STEM careers, and I think that will continue into the future. But there's also a lot to be said for finding that, as they talk about in the Ikigai concept, the overlap between what you're really good at, what you enjoy doing, and what the world needs and what you can get paid for. If you can find something in that sweet spot, then not only are you going to do that career well, but you're probably going to do it for longer as well. And of course, compounding, one of the key components is the longer you can compound your wealth, that's when you get that sort of explosive exponential growth later in the process. If you want to move the car into first gear, well, how do you sort of get off the starting grid? Yeah, usually for people, this is when they sort of move into their 20s. The first part of the process is basically spending less than you earn and start moving money into a high interest savings account. What you need to obviously avoid is consumer debt, because credit card interest and so on, well, that compounds, but it compounds against you. So if you want to get off the grid and start the snowball rolling, well, that's the first thing. You've got to spend less than you earn, which is not always easy when you're younger, I appreciate. And you need to start sort of saving some money. I think at this stage, one of the important things is to start thinking about your purpose or what your goals are. What the why, as Simon Sinek would call it. Because if you've got a strong enough why or strong enough purpose, that's what's going to keep you going over the long term. I think for compounding to work, by its very nature, you need to compound your investments for the longest possible time. And there'll be, almost by definition, there'll be good and bad times. If you're investing over many decades, you'll get recessions, you'll get boom periods. There'll be times when everything seems to go against you or everything's going wrong. You probably have times when you're feeling unwell, or you might get ill, you might lose a job. There's going to be some setbacks along the way. That's almost an immutable law of life. So if you can have a strong enough purpose or goals, whether that's to retire early or to travel, or maybe work towards your dream home, or it might be spending more time with your friends, family. Your purpose might be more freedom, it might be status, but it's worth at this point spending a bit of time working out why you're doing it, because that's what's going to keep you going when times get tough, because it's almost baked in. It's guaranteed, in fact, that there's going to be times when things don't go according to plan. I think it works best if goals are not just a number, for a few reasons. I think partly because the numbers tend to move. I know when I sort of started out, you start thinking, wow, imagine the idea of being a millionaire. A millionaire was seen to be a big sort of status-driven sort of thing back in the day. But of course, these days, most people who own a home and put some money into a pension become a dollar millionaire. And because of inflation and because of lifestyle creep, well, the goals that are numbers-based, you're going to achieve them probably sooner than you think in a lot of cases. So it's helpful if goals are not just a number, it's a purpose as well, because that means you'll stick at it almost effortlessly over time, and you'll keep on going when times get tough. So if you want to move up into second gear, this is now the period where you need to start saving and investing. So you're basically building the foundations for your compounding machine. So at this point, it's probably the hardest period because the growth in your portfolio, if you start investing, it's going to feel like a bit of a grind. You're going to get growth that seems quite linear, and human nature, I suppose, we're sort of hardwired to like instant feedback. It's why stand-up comedians enjoy their live performances, because they get an immediate reaction from the audience. If something's funny or not, they know straight away, and that's the way the human brain tends to work. But at this stage in your journey, the returns from the investments are going to be pretty small, pretty linear. They always say the first 100K is the hardest. I remember that was an old Charlie Munger quote from years and years ago, but it's also in a sense the most important because it builds the foundations for everything to come. So it feels slow. You're going to get small returns at this stage. So 100K invested, for example, in Aussie dollars. Well, if you're making 10%, pretty self-explanatory, you're going to make $10,000 growth in your portfolio. But that's, in a sense, it's like you're sending out a sonar. That's the first echo that comes back. You're sending out money to be invested, and you're getting this echo that comes back. And yes, at this stage, it might only be small. And most of the growth in your investment portfolio is really going to depend on you more so than the investments. But it's just a subtle shift in mindset because you're starting to get the money working for you. I think it almost goes without saying that you should start as early as you can, because time's your greatest friend when you're looking to benefit from exponential or compounding growth down the track. So start early. I guess earlier in your journey, you've often got a bit more freedom before you have sort of more or larger commitments or kids and so on. You've got a bit more freedom to take some educated risks along the way. I think if you start later in the journey, look, it's still better than not starting, but it can create a bit more stress or anxiety, or sometimes a bit of a fear of falling behind your peer group, because that comparison trap can be quite insidious sometimes. And it can also lead to a bit of analysis paralysis, because you feel like, if I can't get this wrong, I've got to get it right. So obviously, the earlier you can start, the better. And basically just start small, be consistent, and just keep on going. Now, if we're moving up through the gears in your imaginary compounding machine car, you want to get up into the third gear. Well, this obviously this is a property podcast. Leveraged investing in the property market. Well, it's the biggest benefit of investing in property for people at this stage in their journey is that you can use your money, but you can use other people's money to invest with some leverage. And ideally, if you can invest in a high capital growth property in a sort of quality investment that you can hold for the long term, well, that's just starting to speed up the compounding machine a little bit for you. I think if you're trying to grow a sort of big, consistent compounding machine, generally sort of slow and steady and consistent growth is best for sustainable wealth. So you're not looking for get-rich-quick ideas or the next hotspot. At this stage in the journey, it's worth spending a bit of time just making sure you understand your structure, your borrowing strategy, your tax planning. It can be quite hard to unpick that stuff later on if you don't get it right to begin with. But basically, time is your friend here, and the maths is just beginning to work in your favor. So if you've got 10% growth on, say, $1 million asset for the sake of round numbers, well, that's 100K. So that the echoes coming back are starting to get a bit bigger. And I think one of the things, it's a bit of a sort of abstract concept, if you like. But I think one of the good things about property investment is there's far less temptation to spend the portfolio. So if you're investing in the stock market, you get dividends coming back, you get capital growth. But then, of course, there's always something to spend the money on. You can go and buy a new car or a holiday or go traveling or whatever it may be. But with the property market, I mean, yes, you can do that by refinancing, but you're not going to sort of start eating the seed corn. It's almost a forced saving mechanism. So that's one of the sort of intangible benefits of property, if you like. I would generally say if you're trying to build a big compounding machine, you want to be investing and not trading. It just takes capital gains tax out of the equation. Slow and steady wins the race here, really. I should also say you should try and run your own race. I think you're always going to be up against people who, I don't know, they might get a big inheritance or they might have a completely different skill set from you. I think it's important to not get too caught up in the comparison trap and just you sort of focus on doing what you're doing really well. It's amazing how compounding works. Eventually, it works out. There'll be good and bad years and periods where you think things are too slow. But if you stick at it and do the right thing and focus on quality, then eventually you will get spectacular results. And don't forget, the ups and downs are to be expected rather than feared. So stay the course, ignore the doomsday headlines, focus on quality, not quantity, and then you're really starting to get underway. Now, a lot of our sort of clients get to that stage, and then they come back to us and say, right, how can I now sort of, if you like, move up through the gears and start speeding up the compounding machine? Well, if you're doing leveraged investing and you're adding some value to properties and you're reinvesting the gains, then that's when you're starting to see the compounding machine start to speed up. So it takes a bit of discipline rather than willpower. A bit of knowledge is obviously important, but I think the more you can sort of have an automated or consistent kind of plan, then this is where you really start to see the benefits kick in. I think it's important to look after your borrowing capacity if you're a property investor. So you need to keep your spending under control. I think there's always a bit of a temptation as your net worth increases to try and, if you're playing the status game, to try and sort of increase your spending as well. So that's something that I think that's natural, but you need just to keep the spending under control. And also just continual learning and adapting, because markets are always changing. So the game here is really long-term investing in risk assets. It's not gambling. And the growth on the growth, well, then you're starting to see that snowball gather some pace and it's delivering the compounding power. So if you can do some renovation, property development, as you grow some equity, you can then redraw equity out of your portfolio to buy more investments. Now, if you're going to do that and you're using leverage, I think it's very important that you need to diversify, ideally. You could invest in all very similar types of properties in one location, but then you're adding some risk there. I think if you do that in Australia, you're also going to pick up some land tax. So that's not ideal. So you need to sort of protect yourself. And diversification, it's like a form of Kevlar, really. It just stops you having the big downside risk. It's also a lot less stressful, I should say. And then at this point, your portfolio is beginning to accelerate and you're starting to create an almost unstoppable momentum, because that magic of compounding begins to work. The journey just starts to get a bit easier. You won't get everything right. That's absolutely sort of guaranteed, but treasure the lessons when you get things wrong and continual learning. And if you learn from those mistakes and keep moving forward, and whatever you do, keep going, because by its very nature, for compounding to work, you can't give up or decide to quit and change course. Compounding only really works if you leave it uninterrupted for the longest possible period of time. Now, we're moving up into the faster gears. If you want to move up to fifth gear, your portfolio growth means your portfolio is continuing to grow even after you're accounting for your spending. So this is the first tipping point. Compound interest is good, but compound growth in your portfolio is actually better and more powerful. And now you've reached the first tipping point. So I think it's you need to be wary of sort of your ego at this point. If you're starting to see sort of gains on your portfolio that are sort of better than you might have expected when you started out. In the end, wealth is just a tool for improving your life, the life of your family, and for your happiness. It's not a scoreboard to keep track of, so you're sort of winning the game, if you like. I think it's, for a lot of people, they start to sort of focus on either freedom or fulfillment or their family and hobbies. And I guess at this tipping point, there's less career stress because you're no longer fearful of losing your job, and you can actually start to focus on things with more meaning to you. And as Warren Buffett once said, time is the friend of the wonderful investment. So even when there's sort of good and bad years, you've just got to keep on going, even if there's doom and gloom all around, because if you invest for decades, you are going to get those recessions and tough times, and it's an immutable law of life, sadly. But if you can surround yourself in your social circle with optimists and long-term investors, then that will sort of help. You tend to mirror the people you spend time with, and that will really sort of help you over the long term. And it will actually sort of elevate your targets and expectations. Now, I think like some modern cars, I think my first car only had 4 gears, but if we're moving up into a 6th gear, which I think my Holden Commodore had a 6th gear, tend to be a manual driver, like a lot of POMs. Well, this is when you're reaching that second tipping point in your journey, when the income on your portfolio either matches or actually even exceeds your employment income. Because now at this point, you're really just having to protect your portfolio. You don't even have to chase growth anymore. You can be more focused actually on protecting your downside and insurance and just making sure everything stays on track, because your portfolio is becoming a self-sustaining compounding machine. You're actually now free to work on your own projects or work on your own business in an area that interests you. So at this point, you want to sort of change your mindset. You want to keep improving and keep building momentum, and the growth just starts to multiply. And I'm not now talking about just your portfolio multiplying. It's your finances, but it's also your experience is starting to multiply at this stage. Ideally, if you keep learning, your knowledge is beginning to multiply. The ideas that you start to generate, even your potential earning will start to increase because your expertise, your experience in life, you've probably got more confidence because you're not just sort of relying on your employment income anymore. So keep studying, keep learning. I think it can be a useful thing as well to actually keep teaching. If you, it's often said the best way to learn something is actually to start teaching it. Some of our lecturers at university, they're only ever sort of one module ahead of the students. And it's a very good way to understand a subject and to become a master or an expert in it is to also teach it. But I think it's useful too, because you can pass on your knowledge and your legacy to the next generation. So I'm just currently in the process of doing some Airbnb properties, and I want to get my kids involved. I want them to learn about how to present a property, how to market it, how to deal with tenants, all of those entrepreneurial skills, because at the end of the day, whether I pay them $100 a week or whatever, it doesn't really make a whole lot of difference to me, but to them, they're learning sort of invaluable lifetime skills. So pass on your knowledge to the next generation at this stage. And again, it's just probably important to have enough discipline to not throw everything away on sort of expensive flexing or outward displays of wealth. I mean, of course, if you want a nicer car, then whatever it is that floats your boat, of course. But I suppose for compounding to have its most powerful results, it always pays delayed gratification instead of cashing out early. And you will find you reach at this stage, you start sort of having a change in mindset, and it's like, oh wow, things are actually going to be fine, and I could actually sell down a few assets and retire. But actually, if you want the compounding machine to keep working for the longest possible period, delayed gratification instead of cashing out early is the way to go. Now, I don't think most modern cars would have more than 6 gears, but let's imagine now you're getting into a Grand Prix car, which if my F1 knowledge is up to scratch, I think they might have 8 gears. I could be wrong. I'll have to check that one. But let's say you want to get up and really speed up the portfolio. Now, not everybody will want to do this, and not everyone will necessarily have the skills or the desire to do this. But what if you want to speed up the compounding machine even further? If you want to join the ranks of the very wealthy or even the super wealthy, well, the third tipping point that you'll need to go through is when the growth on your portfolio exceeds even the best year that you've ever had from income earning. And you start to get to this point where your portfolio is maybe increasing by 300,000, 500,000, maybe even more. And then you're starting to get into a period where without any capital gains, you're seeing gains on your portfolio that are more than you could ever earn from a career. And then you've kind of reached this escape velocity. You're effectively financially free. You can stop stressing about money. And time is now your friend. Time's on your side. It's not your enemy because you've got the compounding machine really working for you. If you're investing in high quality assets, the portfolio will most likely roughly double every decade anyway, even without you doing anything at all. And you get to a point where the portfolio can sustain a withdrawal rate of, let's say, 5% per annum. You may have read about the 4% rule. Well, let's use a round number. If you've got a portfolio where you can take out 5% of it per annum, whether it's refinanced as a line of credit or something like that, and that covers all of your expenses and the portfolio continues to grow, well, now you've really reached the escape velocity. Now, if you want to get into the absolute top gear, up into the 8th gear, well, this is where the sort of business or the side hustles and things that you've started to do, if you actually want to grow your own business in an area you're passionate about, an area you've got some expertise in, something where you can really add value to lots of people, then you can actually start to grow your own business. And then you're using other people's time and the leverage of employing staff and technology or code these days on the internet to grow a profitable business. And then you can reinvest the profits from your business back into your portfolio. Well, now you're into top gear and you're starting to see you've got your business working for you. That's reinvesting into your portfolio's compounding, and everything's humming nicely. And the compounding machine is going to deliver spectacular long-term results for you. Now, obviously there comes a point where enough is enough for some people and they don't need to keep pushing it. Other people are sort of born to fly wingsuits, as they say, and they just want to keep on going, unquenchable thirst for success and wealth. Well, you can go above and beyond this if you really want to supercharge things. But as I say, this is not really for everyone. Not everyone has the willpower or the skills or the knowledge to become one of the super wealthy. But if you want to really sort of head for that and shoot for the stars, well, then you probably need to use other people's money as well outside of your property portfolio. And this would involve raising capital from external investors, probably to grow a startup business. These days, probably in some tech-related field. I guess that's where the big scalable gains are. But this comes at a cost. It's going to come at a cost of your time. It's going to come. It's going to take a lot of energy, and it will involve stress, because if you're using other people's money, you've got external investors who are relying on you. And as I say, not everyone really has not only the willpower, but also this involves a lot of skills and knowledge as well. But it's definitely a way that you can supercharge your wealth. If you want to take your wealth into the tens, hundreds of millions or the billions, well, this is really where it happens in the startup world by using not only other people's money, but other people's time. You're using other people's expertise. You've got leverage from the investment, but you're also leveraging your staff's expertise, and you're using code and the internet, and everything's absolutely sort of leveraged up and maximized and scalable. So, I mean, that's the supercharged way to go. But I'd say for the overwhelming majority of people, they're probably not going to go down that route. If you read the book by Felix Dennis, How to Get Rich, I think is the title. He talks a lot about this right at the beginning, is that if you really want to sort of aim for that kind of enormous wealth, well, it's going to come at a cost that actually most people don't want to devote all of their time, 24/7 to living and breathing, running a business like that. Some people do. It's just, it really depends on your nature. So I guess hopefully you got something out of that from today. So the key things really, you've got to move through those 3 tipping points when your portfolio starts to grow rapidly, then it starts to exceed, the growth on your portfolio starts to exceed your income, and then eventually exceed even your best income earning years. And then you're sort of reaching that escape velocity when your portfolio can sustain a 5% withdrawal rate and continue to grow anyway. And then I guess it's largely then a case of protecting the downside, sticking at it for as long as possible, and not interrupting that compounding machine, because the secret weapon, of course, is time. And if you look at the journey of famously Warren Buffett, that huge percentage of his wealth actually occurred after he was 65 years old. So sticking at it for the longest possible time and looking after your health as well, I guess that's another secret weapon. So we'll finish up there for today. As always, send in your questions, because Chris and I will be back on the weekend to do our 2 cent segment, and we'd love to cover your questions in our listener Q&A. And that's it for today on the 3 tipping points of compound growth and how to build your compounding machine. Cheers.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.